Perfect. Okay, we're all set, ready to go. Okay, so investing can be easy. I'm gonna hopefully show you how. Why is it not moving? There we go. Remember, it's not how much you make in the market, it's how much you keep. So you can make it easily, but you got to keep what you got, right? And this is a quote from Don Vanderborn, who's one of the key managers of an investment firm called Revere Asset Management. And these guys are brilliant. Unfortunately, they don't operate in Canada, because I would, if something happened to me, I would hand my entire accounts over to them because they understand risk management. Okay, disclosure, I'm not a financial advisor. I don't have a license. This is strictly for educational and entertainment purposes. So, I'm not making any recommendations. Don't, blah, 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 blah. So in the last 94 years, the market has had a negative return only 25 times. So by my math, there's a 74% probability the market's going to go up in any 1 year. So that's a good thing. But 4 times, the market's lost 2 or more years in a row. And this is when the pain starts to come. And here's the worst period. So obviously just before, in the depression, 1929 to 1932, the market went down really big, 4 consecutive years. Right in the midst of the Second World War, again, modest decline the first year, and then a couple of moderate declines the next 2. 73, 74, serious recession, 14%, then 26%. And then 2000, with the dot-com bubble, it went down 9, then 12, and then 22. 2008 was the financial crisis. But interesting, the market went up the year before and up the year after 2008, but in 2008 it lost 36% in 1 year.
But on either side.
But it was only 1 year, but on either side of it, it was.
Okay.
So here's what happened in 2022. As any of you who have opened your account statements have probably noticed. The benchmarks that we use are the S&P 500. It was down 19% for the year. The NASDAQ, which is more tech related, down 33. Toronto was only down 10, and this was the first time in 17 years that Toronto actually outpaced the New York exchanges. And the main reason for that is it's heavily weighted in energy, which had a great year in 2022. If you were in oil stocks, you did well. And banks didn't get hit quite as hard, and so they're a little more exposed in those 2 areas. Even if you own bonds, they went down 14%. They're supposed to be a safe haven, but they were still down on average 14%. And then don't even get me started on the cryptocurrencies and other goodies. So my premise is anyone can make money when the market goes up. The key is to lose small when the market goes down. That's really the key to successful investing. And that's hopefully where I can help you guys today. So hopefully that's not too small a print for everybody. Here's an example of what can happen if you don't have some sell rules. I'll go back to the dot-com bubble in 2000. And let's say on January 1, 2000, you had $100,000 in your investment portfolio. That year, the market went down 9%. So at the end of the year, you had 91,000. Next year, the market went down another 12%. So now your account balance is down to 80. And then in 2002, it went down another 22%. So your account balance is now 62.4. So now you need the market to go up by 60% just to get back to where you started. And that's a pretty big hill to climb. Now in 2003, the market did go up 28%, and your account balance would have gone back up to about 80. Still underwater, but you're on the right track. So contrast that scenario if you have some simple sell rules. And I'm going to get into this in the major part of this presentation. Same scenario, January 1, you started with 100. Calendar 2000, the market goes down 9%, but you limited your loss to 8%. Your account balance is 92. Not a heck of a lot of difference between 8% and 9%, but the next 2 years, the market goes down 12%, but you limit your loss to 4%. Your account balance is 88. And on 2002, despite the market going down 22, you limit your loss to 4%. and your account balance is still 84,000. You now only need the market to go up by 19% to get back to even. And in fact, the very next year, the market went up 28%, and you're now positive over that 3-year span. So, I mean, the key is, and we'll get into it, is, yeah, Rick, but how do you limit your loss to only 4% or 8%, right? And there are some really easy ways to do that.
Jennifer has a question.
Yes, the question?
Oh, never mind. Sorry, that should have been.
Oh, sorry. Jennifer, do you have a question? No,
Oh,
okay.
Sorry.
Okay. Had you stayed in the market right through from May of 2000, it would have taken you 13 years and 2 months just to get back to break even. And I'll show that in a chart later on. But I don't have 13 years, my age. And I would argue that you guys don't have 13 years. It's a waste of dead money. There's just no, it should not ever happen. And anyway, I won't get started. So a common refrain you'll hear from investment advisors and the like are, investing in the stock market is risky. Yeah, if you don't have some risk management rules, it is. If you don't have rules for crossing the street, that's risky. You don't have rules for driving a car, that's risky. So it's all about risk management. You can't time the market. Absolutely right. Nobody that I know of ever buys at the very bottom and sells at the very top. I mean, somebody may tell you they do that, they're lying to you.
Bernie Madoff did.
Yeah.
He was good at that.
But what you can do is take the meat out of it. So you give up the first 10% until it's safe to get back in. And then when the market tops and heads back down, you're out again, but you've got the meat of the move. So you don't get the bottom, you don't get the top. Another refrain that you'll hear all the time, you're in it for the long haul, right? You're just ups and downs, the market, you're in it for the long haul. Well, I've said for a long time, if you don't get through the short haul, you're not in there for the long haul. So I just don't agree with that. And then you must be diversified. And here I agree to extent and disagree. And it depends what you mean by diversification. If you're an investment manager, you know, they've got you in real estate and some gold and some stocks and some bonds and whatnot. And to me, that's over diversification. All you're going to do is just get a mushy return over the period of whatever time you're involved in the market. That's fine. Same thing, you don't want to be put your entire portfolio in one stock or 2 stocks. That's way too risky because shit can happen. So there's a balance of diversity. So, and we'll get into that a little bit more. What is a reasonable level of diversity? So if you're going to manage a stock portfolio, I suggest to you it's hard. It takes work. I do it. I'm used to it. I'm trained. I've done it a long time. It is hard. And if it were easy, we'd all be rich. Simple as that. So it's not easy. But that's a stock portfolio. If you're managing your retirement account or your tax-free savings account to get a market return, so you're content with what the market does over a period of time. And if you read any literature, the market as a whole has averaged about 8% gain for the last 100 years. So if you're content with an 8% return over the long haul, there's an easy way to do that. The key, though, is to save you from big losses in bad years. And then it actually gets a lot easier to get that 8% return or even much more because you're not suffering the drawdowns when the market goes down. So now I'm going to show you how we do this. Get out of here for a sec. How do I don't have my glasses today. Can I just shut that like that? Is that going to get me out of the meeting?
You just close the present. No.
Did I?
No, you're okay.
Okay, so I'm going to go. Did everybody see that chart? So this is a simple monthly chart of the S&P 500, which I'm going to refer to all the time. It's sort of the benchmark. It's, for those of you who not aware, the S&P 500 is a composite. It's the 500 largest companies in the publicly traded companies in the United States. and weighted by market capitalization. So it's got the Microsofts, the Apples, the Googles, Teslas, the General Electrics, General Motors, like it's a wide 500 different companies. So when you talk about diversification and you don't want to buy a whole bunch of stocks, what you can do is buy the S&P or one of its equivalents, and you essentially are diversified amongst 500 companies. So if some bad crap happens to one of those companies, it's not going to affect the whole thing. Tesla's gone from $400 a share down to $100 in the last 4 months. It hasn't really budged the S&P 500 too much. It has a bit of an impact, but it doesn't kill you. So that's what the S&P is. So it's commonly used as a benchmark by all financial advisors to compare how are we doing and your account's doing versus the S&P. That's how they sort of, yes.
About the S&P, so when would a company be removed from being in that top 500? At what point would they get punted out of that?
They rebalance it, I think, I don't know specifically, once or twice a year, they rebalance it. So they will punt somebody else and put somebody else in. I'm not sure what the criteria are. I don't pay much attention to that.
So if you have your techs in the S&P 500, how does that relate to the NASDAQ?
They're also in both.
They're
Probably in both. The Apple's in both.
Yeah, okay, cool.
Yeah.
Thanks.
Yeah. So looking at this chart, you can see the periods of time when it's really easy to make money, right? When it's going up. It's pretty simple. What you want to avoid is this period. You want to avoid this, probably this one. And you sure as hell want to have avoided this one in the past year, right? And it's not part of what I was, okay, a diverge. Remember I said earlier at the peak of 2000, this is this point on the chart right here. You can see it got back to that level in 2008 and then whoosh. So it actually took till 2013 just to get back to where it was. So my argument is if you can find a way to get out somewhere up in here, and basically you're staying in cash. And people say, well, you're not earning anything, you're not making anything, you're making cash. Well, you're getting whatever the money market rates are, which in 2022, we're next to zero. So yes, all of 22, you made nothing. Today, I think money market funds are about 3%. So at least you're getting something. I don't know what they were back in the early 2000s. I didn't do that much research. But the point being is if you had got into cash somewhere in here and just sat, your account balance would have just, it's not really showing up very well. What shows up? Your account balance would have just basically stayed flat, maybe gone down just a touch. But then brought here, you'd have been back in the market. So now you're compounding from this point. And so I'm not very good at drawing lines. You'd be up there somewhere. And then you're back in cash again when this nonsense happens. So your account balance stays basically flat. And then back in here, you'd be back in. Anyway, you go right off the chart. I hope that makes some sense. This is why you sit in cash. And we've been sitting in cash for a year now, primarily. And you just sit and you wait and you wait and you wait. So how do we get out? How do we know when to get out? I'm going to change this to a weekly chart just to dive in a little bit closer. So this goes back to 2017. And basically, my rules are you're only invested when the price, the S&P is in an uptrend and the price stays above this line here. Now these lines, there's two lines in this chart. This big magenta line is what's called the 40-week moving average. Very simple. On a daily chart, it would be a 200-day moving average. So it's a longer term trend. And the red one is a shorter one. It's the 10-week moving average. So it's a little shorter in duration. So it's subject to a little more whipsaws. But if you just follow those moving averages and stay in the market when it's going up and when price is above it and get the hell out, and then you get back in again when it's safe to do so, essentially. Questions at this point?
So you basically just take your portfolio and say, pull it out.
Pull it out and
of your
put it in
funds
cash.
And you just put it in cash.
And wait, exactly.
We did that.
And if you have, if you have, with an investment, let's say you're not, I'll show you how you do that within Sun Life, and I can show you how, if you have a self-directed RSP, you can do that very simply. If you have a bunch of money with an investment advisor and they've got you invested in a whole bunch of mutual funds and that kind of stuff, it's a little trickier because they don't want you to move the money, and also, yeah, so it gets a little trickier there. But that's essentially. So my rules, because let's look at the current period of time. Let's zero in a bit what's happening this year. My rules for getting in and getting out are really quite simple. Let's go back to this period here. If on a weekly basis, well, each one of these bars represents 1 week of trading in the S&P. So it's Monday to Friday. Okay, so, and I'm going to zoom back out for a second just to show you one other thing on there. And this happens to be a bar chart. And this little wiggle on the right-hand side just shows where the price closed for that week. So that's the closing price on Friday night for that particular week. To me, that's the most important number for that week. Where it opened, what the range, whatnot is not terribly important, but where did it close? So we go back, just go back here, okay, back here. My rule is, if we have 2 consecutive closes above the 40-week moving average, that's a signal to get invested. Move your money from cash to now the S&P or mutual funds or whatever. Okay, so that to me, it's a clear signal. And then when the price closes 2 consecutive weeks below the 40-week moving average, you get the hell out. You sell, you convert everything back to cash. That's very, very simple. 2 weeks, one, because you can get some wiggles in 1 week.
Yeah.
There's some variations depending, everybody's different. I also have basically what I call an 8% rule. I don't want anything to go backwards on me by more than 8%. So I'll measure from the top, say last week's close. I'll calculate what is 92% of that. That's an 8% loss. And that will be my trigger point, regardless where it sits on the chart. But that's me. So you could have a bit of both. What I would suggest is, let's say you have, if we're in this period here where you're riding nicely above the 40-week moving average, you sell half of it, convert half your money into cash. And then if it does keep on going down, you sell the other half as soon as it closes below the 40-week moving average. You're not ever going to get the tops. You're not going to get the bottom. You're just trying to get in protection mode for longer term if you get this kind of stuff where the market goes down 20, 30%.
So while you're watching that, are you watching which markets are actually on the uptick? So that every 2 weeks that you might go back into investing, not like taking out of cash back into the market. You're picking at any time, any kind of different.
You could. That's getting a little more sophisticated. Absolutely, that's what I do. But the whole premise of this is to make it simple.
Mm-hmm.
So really, the time you have to spend doing this is like every Saturday, once a week. What did the market do this week? And so you could say, well, I want to know what the S&P did. I want to know what NASDAQ did. I want to know what the mid caps did. That's a little more level of sophistication and what have you. I would certainly encourage that because some of them are stronger than others. But generally speaking, when you step back, they over the long term, they pretty much go lockstep. For periods of time, the NASDAQ will outperform. But you're getting into more than most people want to do. Most people want something simple that I can just look at on Friday night or Saturday morning, once a week. Where are we at? And make a decision. Do I invest this week or do I sell this week or do I? Simple as that. So looking where we are now, I've been in cash since April. In my longer term accounts, my daughter's account has been in cash since this peak here. We got a little fake out here. Took a small loss. But we're getting closer to getting maybe back invested from cash. This week, if we close right where we are here today, we still have one more day tomorrow, that'll be the first close above the 200 or the 40-week moving average, which is pretty significant. It's not the first one. I mean, it did up here, but didn't hold. You see what happened when you do it only 1 week?
Can you scroll in a little bit, so you're looking at the 40-week average?
Yes.
Can you just pan it out a bit?
Back like this,
Oh, no, make it bigger.
make like this.
Yeah, so you're looking at a 40-week average, and looking at 2 consecutive green bars above that 40-week.
Correct.
Gotcha, okay.
Correct.
So I'm-
Technically, I don't know one there.
Technically, right here,
Yeah.
yeah, right here was a little bit of a fake out. Well, I bet that's August, was it? Or when was that?
Just before December.
Just before December. Yeah, so technically you could have been suckered in. But I have another rule, which I think I explain in the further slides.
Well, that was the one.
When this moving average is going down, you don't put your entire account in. If you want it going up, then you can feel safer. So you might have put, I think I have a little YouTube blog that I do, and I think I recommend that people it's time to put 25% of your account into it. And so you would have put 25% into it. And if you had said, okay, I'm willing to go, where's the close here, right here? Actually, you wouldn't have gone in because this is Friday night. It closed here. But odds are pretty good Monday. See, the next week it zooped down already. So
You would have put the money
didn't close
into
at its
the-
high.
you might have, if you were followed your rules and said, okay, I'm going in Monday morning, yeah, you'd be in. But did this decline ever go more than 8%? I can't read that. What's that percentage? Exactly 8%. So yes, you probably could have lost 8%, but if you only had 25% of your funds in, your total portfolio only went down by 2%. Not a big deal. You can overcome that in a heartbeat. We're trying to stay out from losing 22% and so on. So that would be, yeah, the more significant thing. When this line is going down like this, you just tiptoe in. When this line goes back up. So just the hard part, if the market from here goes, I don't have my glasses, this is not good.
Trend line.
No, I don't want that.
Stop price.
Oh, I don't have it on this chart because I'm on a different computer than normal. But if the market rips up from here, that's a piece of cake. That's easy. We're gonna make money. If the market just goes straight down from here, that's easy. We stay in cash. Wait and wait and wait. The worst part is if we dip above, we come down below, we go back up, we come back below. You can get ripped up a little bit. So you get a lot of what I call paper cuts. You could lose 1%, 2% here, this kind of thing, and it all adds up. So that's the worst kind of environment we could get into in the next year or two, where we just go up and just sort of do this.
When you see cash sitting really flat for a long time, do you ever lock into GICs?
I don't, and I don't recommend it. We can't predict the future. If I knew that the market was going to do this for the next 12 months, then I would highly recommend it. Yeah, go into a GIC because now you get up to 5% or 6% return. We don't know that. We just follow, like we react to what's happening. So I'll settle for a lesser rate of return on my cash because I know when I get back in the market, you're gonna make a lot more than that extra little interest that you've forgiven because it's gonna go up. And if you knew the market was gonna go down for the next 20, that's a different, but who knows that?
Yeah.
Does that make some sense? So let's get out of here and go back to the from the current slide. So easy to manage exit rules. So here, this is what I was talking about. Invest 100% if the SPY has 2 consecutive closes above the 40 and the moving average is not trending down. If it's trending down, yeah, we do get 2 closes and dip a toe in, 25%, 50% perhaps. And then the sell rules are easy. If the SPY has 2 closes below its 40-week moving average, you're out. Or you could say, okay, I'm only willing to take an 8% loss and cut your loss at 8%, or do a combo of both. But the key is get out, because it's so easy to get back in. Like I could buy, if I had the buying power, I could buy $1 million worth of the S&P 500, and my commission on that is $4.95. Like your transaction costs are nothing. So if you sell it and you say, oh crap, it turned around, you can buy it back. Not a biggie. A little more advanced or a little more exit rules. If you could, if the SPY has 2 closes with a moving average trending down, invest 25 to 50. I just talked about that. And then you add your remaining 50 when the moving average lines turns up. And the exit rules are essentially the same. I can make this PowerPoint available to you if you.
That would be great.
Yeah. So most of my RSP funds are with Sun Life. How can I manage my portfolio between cash and the mutual funds they offer? I think was one of them. So when you log into Sun Life, I don't have a RSP there, so I can't log in. But when you go in there, there is a section where you can allocate. And right now well, I don't know how you're allocated, but if it were me right now, I'd be allocated probably 75% cash, 25% in one of the funds, okay? Which fund, we'll get to in a second. So you can go in there and you can select, and I'm not sure how often you can change your allocation, what the rules are. I think it's every 30 days or something. I don't think they want you changing it every day.
There is a rule about.
There is some rule. I'm
About
not,
how often you can do that.
Yeah.
But what do you consider the cash ones on there?
cash one, I would only go to the money market fund. There's one called money market.
Money market?
Yeah. The others are, you're locking your money in for 90 days, 120 days, 360 days, which is, it's okay. If you really think the market's going to be crap for that period of time and you want a little higher rate of return, that's fine. I'll give up a little bit of that so I got the flexibility to get back in again. Which Sun Life portfolio should I consider for my cash or my investments? I've actually went into Sun Life's thing. You're limited to how many mutual funds there are. There's not a lot. And I just did a very cursory look at each one of them. And there's 3 that sort of stand out to me as giving you a really good return. There's some of them that give you a lot of protection when, you know, they're heavily weighted to bonds or mix of cash and whatever. So to prevent losses when the market goes down. Well, how's that working out for everybody? Not so good. So I don't care if they protect me on the way down. I just want to maximize my gains going up. I'll look after protecting me on the way down by using simple sell rules. I'll just sell your fund. Thank you very much, and go into cash. And when things turn around, I'll buy your fund back. So there's 3, and if anybody really wants to, I'm not allowed to give advice. I'm not giving any, but I did some research. There's 3 that sort of stand out that if I had an RSP with them, those would be the vehicles that I would choose. So there's some that are a lot better than others. And then the last thing, how should I manage my RSP or TFSA that are with a direct access broker, so E-Trade, RBC Direct Questrade, or whatever, because some of you probably have especially tax-free savings, are probably through self-directed. Again, back to Leslie's issue, there are a number of vehicles. You got if you just want to go with indexes, there's 4 or 5 to look at. XIU is Toronto. I rarely use that because for a lot of years, Toronto's outperformed the US, so I don't really care. There is exchange risk though when you go buy the S&P 500 or one of the US ones, because now you have to have US dollars in your account. So that worked positive for me this past year because the Canadian dollar lost. So I actually, even though my account balance went down a bit, by the time you factor in the currency, the Canadian balance actually went up. So my benchmark would be the S&P, the SPDR, SPY. That's what every mutual fund manager, fund advisors, that's their benchmark. I would tweak that just a tiny bit. If you have I say $100,000 or more in the account. Rather than SPY, I would use SPLG, which is exact mirrors the SPY, except it's about $46 a share versus 200 or 3. I don't even know what the SPY is. But that's not, the price difference doesn't make any difference, is not the driving factor. With the SPLNG, the S&P pays a dividend because they collectively get the dividends from all 500 companies that pay dividends. And they hold on to it for 5 weeks, the dividend. And then they pay it out to you. The SPLNG is a mirror image of it. They pay it out in 5 days. So if you got a sizable account and the dividend is actually, $2,000, $3,000, $4,000, $5,000, the fluctuations in price in percentage terms are exactly the same. So I don't know, I'd rather get my dividend a little faster, so.
Is there an advantage or disadvantage of working your TFSAs through, say, if I use my E-Trade account or if I use like Sunlight?
Nobody here from Sun Life, right? I would definitely use E-Trade or whatever. You're paying $4.95 or maybe max $9.95 commission.
Okay,
Sun Life's going to charge you 1% minimum, just an annual fee to manage it.
yeah,
And their transaction costs are significantly higher.
okay,
So on a fee basis,
go with my E-Trade account, okay.
it's a little more work on your part.
Yeah.
The advantage of it is you can place a stop loss order. So let's say, I'll use a stock as an example. Let's say I buy a stock, it's $50 a share, and I'm willing to risk 5%. So if the stock goes to $47.50, I want the hell out.
Mhm.
And I don't want to manage, I don't want to be watching it ticker by ticker by ticker. So when I buy it at $50, say I buy 1,000 shares at $50, I immediately put what's called a stop loss order in. And if the price touches $47.50, I'm sold, I'm out. And you place it, I place it, all my orders I place stop loss order within 15, 20 seconds of the time I make the buy order. It's just discipline for me, it's just automatic. And then you forget about it. Don't even have to worry about it. Maybe you want to set an alert on your, if you got Questrade or RBC, they'll get you alerts for various prices. So you might get an alert, especially if it's going up. But that's one way of doing it. And the second thing is you could also, let's say, then if the stock goes up, you got to think about where should I move my stop, So they also have what's called trailing stop losses. So you could trail it by 5%. So if the stock goes to 60, now your stop loss is going to be set at 57. So it automatically just trades it up. And you don't have to look at it, you don't have to manage it. And that's what I would do, especially if you don't want to be paying a lot of attention to it. Pretty simple. You can't do that in Sun Life. So just move on a bit here. So here's some sobering math about how much you need at retirement. And it's a hypothetical situation. Everybody's obviously different, but anyway, so you want to retire at some point. You don't have a company pension plan. We're not Ford Motor Company and General Electric or whatever. So you're relying on your RSP and your TFSA as your main source of income when you retire, supplementing your big Canada pension. I'll assume your house is paid for, so that's a good thing. And assume that you require about $100,000 in pre-tax income for living expenses. So vacations and taxes and, yada, yada, look after the grandkids and blah, blah, blah. So you can go to any wealth management site. I think you can build some criteria in there and they'll do it automatically for you. But this is the scenario I picked up. So if you're in this boat, what do you need? So if you don't want to go backwards on your investment, you need an 8% return to cover your living expenses. And simple math then says you need an investment portfolio of 1.25 million. Okay, because 8% of 1.25 million is 100 grand. That's what you need to live on. No problem. I've got that much, or when I plan to retire, or blah, blah, blah. And the market has produced an average return of 8% for the last 100 years, so we're good. But what about the fact that 26% of the time the market actually went down. If you'd retired a year ago, December 31st, 2021, you had the $1,250,000, you subtract 100K for your annual expenses. But oops, your 1.25 million actually dropped another 20% because the market went down 20% last year. So now your portfolio value a couple of weeks ago is like 900. Oops. But you know, that happens. But let's say, God forbid, the market goes down in 2023, who knows? I mean, we got a war, we got recession, we got interest rates still climbing. Like, we got a lot of bad things that are still happening out there. Let's say the market goes down another 20% in 2023. I'm not predicting it, but you got to protect yourself. So here's your new math. So now, a couple of weeks ago, we had 900. We're going to take out 100 during the year to live. We lose another 180 on our market going down 20%. Now we're down to 620. Oh shit. So now you're facing the challenge of either reducing your lifestyle or selling your house to finance your life. Now, if you'd followed what I call my get out of the market rules, you're still going to be down. There's no getting around it. But you'd only be down to 908 by the end of 2023, which is still not healthy, but you're not in crisis at that point. Now, if we go down to third year, that's a whole new ballgame, but that hasn't happened very often. But if you get, anyway, it won't take near as much to get back. So that's some math I would encourage all of you to do is say, okay, what do I really need when I retire on what living, and then work backwards from there. How much have I got today? And so then what's the rate of return I need to get from where I am today to when that time is I want to retire? And if it's a huge delta, now maybe you need to be a little bit more aggressive, and you're not going to make it an 8% return a year, so you're going to need to find a way to get more. Or if it's not much of a delta, and 8% is going to comfortably do it. Right. So anyway, get your thinking that way. I can't help you with that. That's an individual thing with everybody, but I just want to plant that seed, that something to think about. That's it. A lot of stuff there to digest. Questions?
Yeah, I think you mentioned how we get our money out of sunlight.
How do you get it out of sunlight?
Yeah.
You can. They make it hard. When I was here, and I had I'm no longer allowed to, at my age, I'm so old that I'm not allowed to have a RSP. I got permission to withdraw and move it out. So I don't know that's automatic. I think recently somebody did it, but I think we had to get permission from my brother, who is sort of the Sun Life go-between.
It has to be an officer of the company, has to sign an authorization.
Yeah. Yeah.
And it has to be going to another registry.
It has to go into a fund. I mean, you can't withdraw because now you're going to pay tax on it.
Yeah.
So, and I don't think you can initiate it through Sun Life. You have to initiate it through your self-directed broker who make a request. So they know that it's going from one self-directed account to another self-directed account.
Will that impact our RSP contribution matching at all, like if it's
No.
not at Sun Life?
No.
Okay.
No. Now,
You have to
I think
do
Sun Life would
it.
get pretty cranky if the entire company just said, they got notice next week to say, we're all withdrawing our money from Sun Life. Oh, by the way, we want to stay with the plan because we still got the matching going on, right? They still collect the contributions and we still have the matching going on.
Right.
But the money under management just went from here to here. They're going to get a little cranky about that because that's how they make money. They're charging, I don't know what collectively is in the pool. It's got to be a lot, and they're picking up a nice sweet 1 to 1.5%.
Well, then your voluntary portion of your, if you have a voluntary portion to your monthly contributions, those are fully 100% within your own work abilities. It's the 4% matching or 3% or whatever you may do that is under more of the restrictive
Right.
guideline. But anything that's voluntary, you could
It's
totally,
your money.
yeah,
It's your money, you can do
anytime.
it. Okay, yeah.
So what's your recommendation when you realize that you have funds, RSP funds all over the place? From previous employers, previous investings, and you realize I've got RSPs here, 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 and here.
Yeah.
At what point do you say it's a good idea to kind of consolidate so that you kind of have an idea where you are?
Tomorrow.
Okay, so you would do it like right away?
Yeah, there's no point. It's it's too much to manage.
Yeah,
And so if it's too much to manage, you don't manage. So you just let it sit there.
yeah.
And you don't open your account statement. And then 3 months from now, you open your account statement, oh shit, I went down 12%. You know, that can happen.
Well,
So,
and now that we're all paperless, if you don't actually get statements coming to your email.
Yeah.
Like, we had a situation at home where I said to Ken, do I remember we used to get statements from somebody? Hey, we don't get those anymore. Do you still have that? Now we're like, I don't know, you know, like you totally lost track.
yeah.
And that just seems like it's a bad idea.
Yeah, it's, I guess, if you're willing to put a little bit of time in to manage it, just not a whole
Yeah.
lot, then absolutely bring it all together.
And how do you decide where you put it? Like, what?
But all brokers are the same.
Yeah.
I mean, there's no difference between Questrade, between RBC Direct, between E-Trade,
Yeah.
between, I don't think, I only have accounts
So you
at
just
2.
like pick one and,
Pick one that's it gives you the best service. And the advantage of having, I don't know if it's an advantage, but by having a direct access to any one of those, they got those charting platforms that I just showed you on mine thing. Okay, they won't be near as sophisticated, and you can't have all the tools and stuff. But I can show you how to set up the chart so that once a week you just look at the big weekly chart of the S&P 500 or the NASDAQ, whichever one you want to follow, and they've got it there for you for free. So just pick, I'd say just pick one. Unless you've got millions and millions of dollars, then there's some risk of one goes bankrupt or something, you know, then you might want to spread it out, but yeah, having multiple ones, to me, doesn't make a lot of sense.
Hey, I had a question over here.
Yes,
So obviously with like the company RSPs, you know, that's going through Sun. And for me, I have same kind of thing. It's going through Sun. And yet I have some RSPs of my own, so does Leslie, etc. But it's kind of one of those things where would your recommendation be fair enough that for the employer kind of side of things, it's like leave it in Sun, just let it kind of sit in there, and at some point, if/when possible, transfer it out to something like RBC Direct or whatever. But barring that, take everything else that you have not related to your current employer and kind of consolidate it in one place, such as RBC Direct, and then tether that to like the difference between an S&P based fund or just a money market fund, depending on the lay of the land.
yeah, exactly. I wouldn't, the Sun Life, I wouldn't be in a rush to, if you're just gonna you're content with a return with what the market gives you, leave it at Sun Life. There's 2 or 3 funds there that actually mirror pretty much with the S&P 500. So the only decision you're making, am I in that fund or am I in cash or am I a little bit of both? So you're not making a lot of decisions. But if you want to get what I would call superior returns, because you're going to put a lot more work into it, you're going to do more study, you're going to actually get a basket of stocks or maybe a basket of exchange traded funds that are sectors. And so you're going to spend more time at it because you want to get, instead of getting 8% as an average, you want to get like 24%. Then you might want to consider moving it out. But most of you, I don't think, are in that boat.
So what about right now, where fundamentally, like, the market is flat or declining right now? It's not exactly clear whether or not in 6 months it's going to be on its way up or not. But like at this point, if anybody puts money into any fund that Sun is currently managing, so not a cash fund, but any kind of RSP thing, fundamentally it's basically going to go down. It's or not grow. So I'll be generous and say it's not going to grow, which means that right now you kind of don't want any money to go into that. But like to go into Sun and turn around and say, just keep changing the fund every single month or week or quarter or whatever, like number one, they don't necessarily like that. And number two, to transfer money in and out, you're gonna pay, charges and stuff on that. So what do you recommend to do in terms of like where you're putting the money in that's going into Sun that you kind of don't have a choice because, the employer's doing it and you have your own personal match that's going into it?
Well, as I understand, you can allocate. So you can say that from this month forward, whatever the amount that you're putting in plus what the company's putting in, I want 50% of it to go into cash and I want 50% of it to go into XYZ fund. So
And you
can
don't,
say- and you
and
don't
we
have,
don't charge for changing that allocation?
you can change that allocation probably once a month, but you're not likely to make changes certainly more frequently than once a month. And if you're like passive, just investing in the S&P, you're probably not going to change that allocation more than 2 or 3 times, a couple of times a year. So it's not a big deal unless you're in a whipsaw market. You shouldn't need to be changing it that often. If I get your
Okay.
question.
Yeah, fair enough. Yep.
Yeah. And then their fees, I think they do have a fee the only time they charge a fee, I think, is if you want to do it more than once a month, more than what's allowed, they'll do it, but they charge you like $25 or something. So again, that shouldn't be a deterrent. $25 fee shouldn't be a deterrent. But what I'm trying to teach, if that's the right word, is if you're interested in trading more frequently than that, then this is the wrong environment. I can help you separately on that. But this is for people that just don't want to pay a lot of attention to it. But I recommend that you do pay some attention to it. I mean, for most of us, our RSPs is our second biggest investment after our house. Our house is our biggest investment, and we sure as hell look after our house. And a lot of us don't pay any attention at all to our second biggest investment, which is
I
our.
would say it's really easy just to forget about it.
It's just forget about it. It's just somebody else is managing it. That's fine, but look at that sobering math.
Yeah,
If you want to get there, you can't be having 20, 30% drawdowns in the course of a year. That more questions, or are we on budget? We're right on budget for time?
Great.
Thanks, Rick.
Rick,
Thank
Rick,
you.
Okay. Sorry?
If you're unsure, Mel, Jennifer can see us on Zoom.
There we go. Yeah, I hope that was helpful. And if you got any individual questions, again, I'm not a registered advisor. I'm not allowed to give advice. I don't give advice. Take it for a grain of salt. It's just for education. But it just has driven me nuts for a year watching some of my family, a lot of friends, people I play golf with, and watch their net worths deteriorate by 20, 30% this past year when there's no need for it. I mean, I had a bad year this year. I was down 10%. I've picked up 3% of that already this week, but that's another story. But I was down 10%, which is the worst year in my history. And it's carelessness. I was just not on the ball last year. I was doing a lot of stupid things. So it can be done.
I can't say the thing too, I used to manage your golf swing, it's phenomenal, so.
Oh, that's great. Thank you, Rick.
Thanks,
Super
Rick.
helpful.
Okay,
Thank you, Rick.
all right.
Once you learn.
Thank you.
Thank you very much.
Bye, Roland.